2021 was a blockbuster year for IPOs, more than 1,000 new issues, plus direct listings, a surge in SPAC deals. It was a busy year. This year, market debuts have slowed to a trickle, and the companies that started trading last year, the class of 2021, as I like to call them, they've taken a steeper hit than the overall market as measured by the Renaissance IPO ETF. I'm joined now by CEOs of two of those companies that came public last year, Nubank CEO David Vélez and Brilliant Earth CEO Beth Gerstein. They also, by the way, are co-founders of their respective companies. And I talk about this theme a lot, that there were so many companies that came public in 2021, and there aren't too many of them whose stock prices, at least, have gained. Whether their fundamental businesses have done well is a very different matter. So I wanted to kind of tease that out a little bit. But I do want to start kind of in the beginning with both of you. David, you co-founded Nubank in 2013. Beth, you co-founded Brilliant Earth in 2005. How did you each decide to make the decision to go public last year? What made you decide to kind of pull the trigger? Beth, I'll start with you.
For us, it was a natural evolution. We've been operating for 17 years. We were growing. We were profitable. We had, I think, a lot of discipline, originally being bootstrapped. And so we thought it was a good time for us to be able to raise a little bit of money, for us to allow our team members to participate in owning part of the company, which I really am proud of. And I think we were right. It was a good time for us to go public.
David, what about you?
Yeah, about 2019, we started thinking about going public and getting into a process of about 2 years preparation. We obviously started seeing a lot of private funding available, but we are a business that requires a lot of capital. And at some point, it was very clear that we were going to go public to need to really access that liquidity. We had also been building Nubank already for about 8 years. So we put a stake on the ground in 2019 that by December 2021, we were going to do it. As the market went in that direction, 2021, we decided that it was the right time, and we were very happy that we were able to sneak in right at the end.
Yeah, you made that deadline just. And I was looking at how the stocks have performed. Beth, your shares were up 42% on the first day. Your shares went up around 32% over the first couple of days. They have trended lower, right, with the rest of the market. We've seen, like I mentioned earlier, most of the companies that came public last year, that's their trajectory. And I ask a lot of CEOs about their stock prices, whether they're new issues or whether they've been on the market a long time. And most of them say, well, I try not to pay too much attention to the stock price, which you got to pay some attention to the stock price, right? So, David, how do you think about the stock price action and how you interact with investors when you see the price going down?
Yeah, so it took us, I would say, we priced the IPO in December, and then we went into this market, and it took us a few months to try to figure out what was happening. What was the market telling us with the sudden movement in price? And after about 2 or 3 months of trying to understand what was going on, we kind of came to the conclusion that our thesis that the largest provider of financial services in the world, especially in emerging markets, will continue to be technology companies, and that the thesis fundamentally had not changed. And in fact, there were some trends in a market like this one that makes our business way much more interesting than a year ago, even though the market is a little bit more painful and the price is really not being able to price that effectively. And so what's happening is that effectively companies, everybody in tech is being traded the same thing, is being punished the same thing. But there's some whose fundamentals are unaltered, whose thesis is unaltered. That's our case. We're profitable. Brazil and Latin America, macro seems more concerning in this environment, but we've actually have a very positive view since the very beginning. And Brazil will actually grow 3% this year, more than China, with an inflation lower than the US. Colombia will grow 8%. So you start seeing a bit of a decoupling, at least through this year. I think next year will be a little bit harder. But in reality, what's happening is that everybody's sort of put in the same box without really understanding the differences between the different tech models or the geographies or profitability curve or any specific details about the company.
Well, and it's not even just tech, right? It's sort of like everything has been thrown into that basket. I mean, you guys at Brilliant Earth are sort of tech first, if you will, but you're a retailer, right? You sell diamonds and different kinds of jewelry. So it's interesting that you two are two different companies, different types and categories, but yet, you get this whole tarred with the same brush thing when everybody's looking at these new companies. You mentioned a moment ago, you don't get the timing. You think it was good timing still for the company. So how do you think about the stock price and the reaction that we've seen?
I agree with David. Like, direct to consumer has been a more challenging sector as a whole. And I think you end up getting lumped in with all of the companies that ended up going public at the same time period. We're very different. We've been operating for 17 years. We've been growing and profitable, continue to be growing and profitable. So I think it differentiates us, but investors are still learning. And, frankly, I think right now, they're not really taking the time to look at each company. They're overwhelmed based on just some of the volatility. So for us, it's really about how do we, not pay too much attention to what the stock is doing on a day-to-day basis. Make sure obviously the team is motivated and that we're focused on the long term while making sure that we have the discipline in the current environment.
And it seems to me that both of you are probably in modes where it's not as though you would use your stock to go out and acquire, that you're sort of organically growing. Would the plans have been different if the stock price had done something different, Beth?
I think that, at this point we have a really strong balance sheet. So we have a lot of strategic options that are available to us, whether it's cash, whether it's, how we want to think about organic growth is actually traditionally how we've been growing for the past 17 years. So I feel like we're really well positioned. We don't, it would be nice to have that lever, but we have a lot of other opportunities as well.
David?
Yeah, the organic growth is definitely the preferred growth stage at this time. We have already over 35% of the Brazilian adult population is a customer, but we have less of that market share across all the different financial services products. So we have significant opportunity to grow with the cross-sell to that very large base, almost 70 million customers. In Mexico and in Colombia, our new markets, we've already the largest credit card issuer. So a lot of opportunity to grow organically, and we're seeing less competition in the environment. However, we raised more money than we needed last year, and we are seeing some potential M&A targets that we were discussing with 12 months ago back on the table at a valuation discount of 50, 60%. So both organic and inorganic opportunities actually seem more interesting in a market like this one for somebody like us that is fully capitalized than competing 12 months ago.
I agree. We have a real opportunity to take share in a volatile environment. And I think that, that is a unique thing in this market to really feel confident to do that.
Right. If you have a good balance sheet, as you were talking about.
And a good position.
Right.
That's the key. Good brand.
Let's also talk about the bigger environment, right? And recession talk, which of course has been everywhere. You were mentioning that Brazil is still predicted to grow this year. The U.S. is expected to still grow, even if it's not growing very much at this point. But what are you seeing from consumers right now? What are you expecting for the holiday season, for example? Talk to us about the tea leaves that you're reading.
Well, as a public company, we are in our quiet period, so I'll just start off that way.
What can you tell me sort of high level about what you're seeing?
From a high level, I think what we are really proud of is the positioning we have in our market. We have a really strong brand for Gen Z and millennial audience. Love persists in all different types of ups and downs, where people continue to get engaged and people that continue to celebrate with jewelry as a source of value. And we're well positioned because we're very asset light. So I think a lot of other companies have big inventories that they need to be able to discount. For us, we're very inventory light. We're able to scale up to meet the consumer demand. That puts us in a really powerful position. So we can really navigate no matter what the current environment is. And it has been a volatile market. I've said that in the past, and we're expecting for this holiday to be able to meet the customer where they are. And that's all I can really do at this point.
When you say you're inventory light and asset light, how does that work for you? Like if someone's ordering a ring or whatever they're ordering, do you then do sort of on-demand ordering? How does it work?
Yeah, so the way we operate, we work with a virtual diamond inventory model. So the diamonds that we have, which is over 200,000, are actually on our supplier balance sheet. And then a customer will order a ring and we will make that to order. So it really depends on having very strong supplier relationships. And those suppliers are ready for us to scale up as we see the demand actually happen. So those typically take around 1 to 2 weeks. So the customer gets a highly personalized, really beautiful, unique product, and we don't have the inventory risk, which I think in this environment specifically is going to serve us really well.
Yes, we've heard a lot of inventory build news from all kinds of different retailers. Let's get back to economic activity for you, which is a very different picture because we are talking about emerging markets here. You mentioned the Brazilian growth picture for this year. Next year, a survey of economists by Reuters found that they're looking for growth of about 0.8%. So still expanding, but at a much slower pace. Again, what are you sort of seeing through your customer base, and what are the indications? Does it feel like a recession is coming down the pike at some point?
What's interesting about us is we grew, since we started business in 2013, we've effectively only grown through recessions. And it's interesting to talk to other U.S. companies when they see, it's being talked about inflation and low economic growth as something that nobody has really ever seen. For us, it has been Brazil 101. We've only seen recession. We've only seen high inflation. We saw a 7% GDP contraction in 1 year as we grew. We saw the worst recession in 100 years. So as we look at 2023, yes, it's going to be more moderate growth, but relatively to what we have already experienced, it's actually much more positive. And a lot of the trends that we're banking behind are almost uncorrelated with the market. Regardless of where the market grows 1% or 3% or 5%, more people will go to digital banking because it's a better experience, it's lower fees, it's lower interest rates. Regardless of the growth, you have 250 million in Latin America that has no access to banking, that are migrating into digital banking. And so a lot of the technology trends underlying the growth of the business tends to be a bit uncorrelated. We definitely have credit risk, and that is the part of our business that is linked to the economy. So we have to have increased resilience in an environment like this one. We've been increasing resilience through the year. But in general, what we've seen so far is a bit of normalization from very abnormally low credit delinquencies through the pandemic. So much more going to normal basis where you still can operate with very healthy margins.
So circling kind of back to the beginning here. So we're going on a little more than a year since you became a public company, almost a year for you to be a public company. What's the biggest change for you in sort of, whether it's biggest lesson learned, biggest discovery, biggest lifestyle change? Are you running around more? What's the biggest difference?
Yeah, I'd say transitioning from private company CEO to public company CEO, it's a big change. It's humbling. I think being able to balance the long-term strategy, articulate the long-term strategy, and also be able to deliver on expectations is, for me, I think a good lesson to learn. I think it's made us stronger as a company. We've been more transparent with our team, with outside investors, and I think that also helps to clarify internally. Like, we are really going after being the number one destination as a fine jeweler for this younger consumer. We have this really strong omni-channel strategy. We're really expanding in fine jewelry. So all of that, I feel like we're able to deliver as that long-term guidepost while still making sure that we are we meeting guidance? Are we able to talk about what's happening in the quarter? So holding ourselves to that standard, I think, is what the challenge is, but I think it's driven a lot of internal accountability.
Interesting. David, what about for you?
Yeah, I would agree with that. I think first, obviously, communication is probably the biggest challenge. Is you need to be actively communicating with a number of different constituencies, especially when there is so much volatility in a market like this one. Things are changing so much. And beyond that is, obviously, we don't want to change our view of optimizing the company's value for the long term. We think that that's still the right way to run the company. But we need to be able to also show investors that in the short term, we have very high rigor in terms of the decisions that we're making, and that there has to be really strong economic fundamentals in the business. So it's balancing the rigor and the communication that we're doing the right things in the short term with continue to double down on the long-term opportunity that the business has.
And I think because we're both profitable, it makes it a lot easier. We're coming from a position of strength.
And that's a differentiator, too, among those public
right.
debuts. Really quick question for you. Most popular cut among engagement rings right now. One of our young producers wanted to know.
Oval.
Oval. Interesting.
Shapes, yeah.
Okay.
Elongated fancies are really popular.
Does it change a lot?
It changes over time. Yellow gold's really popular now. Couples are making decisions together. They're definitely changing trends in the industry.
We'll have you back to talk much more about
Great.
all of that. And we'll have you back too, David. Great to be with both of you. Thank you so much for being here. David Vélez of Nubank and Beth Gerstein of Brilliant Earth.